Have you ever wanted to invest in cryptocurrency but felt nervous about the massive price swings? One day, Bitcoin is making headlines for reaching new highs. The next day, the market drops by 20% and everyone seems to panic. So how do experienced investors gain one simple idea that's often discussed is the 5% rule. In this video, you'll learn what the 5% rule is, why many investors use it, how to apply it to your own portfolio, and the biggest mistakes to avoid. Let's get started. Cryptocurrency has created millionaires, but it's also wiped out fortunes. Bitcoin has experienced multiple drops, and many smaller cryptocurrencies have disappeared. It's about managing risk. The 5% rule offers a balanced approach that allows you to participate in crypto while protecting the. Don't invest more than 5% of your total investment portfolio in cryptocurrency. Don't invest more than 5%. If your portfolio is worth $10, invest no more than $500. If it's $50,000, your allocation would be $25 in cryptocurrency. The remaining 95% stays in investitional assets or emergency savings. This way, crypto becomes a high risk, not your entire financial strategy. Why only 5%? It won. There are three main reasons. A coin worth $100 today might be worth 50. Small limits the damage if the market crashes. 2. Protect your wealth. Imagine your portfolio is worth $100,000. Even if crypto lost 80% of its value, financially about 4%? No. 3. You still benefit if crypto booms. If crypto doubles or triples in value, your portfolio enjoys meaningful growth. You participate in the upside without betting everything on one asset. Let's compare two investors. Invests 100% in cryptocurrency. If the crypto market drops 60%, portfolio also loses 60%. Recovering from that can take years. Investor B uses the 5% rule. Portfolio: 60% stocks, 20% bonds, 15% gold, 5% crypto. Even if crypto crashes 60%, the total portfolio loses only around 3%. That's much easier to recover from. The key lesson? Diversification protects your money. If you're following the established cryptocurrencies, many investors choose Bitcoin, Ethereum. These have longer track records, larger market capitalizations, and most alternative coins. If you're new to crypto, avoid investing large amounts in meme coins or projects you don't fully understand. Remember, don't invest because of hype. Invest because you've done your research. Common mistakes to avoid. Mistake 1. Putting your emergency fund into crypto. Emergency savings should stay safe and easily accessible. Mistake 2. Borrowing money to buy crypto. Mistake 3. Trying to time the market. No one consistently predicts market highs and lows. Instead, use dollar-cost averaging, investing a fixed amount regularly. Mistake 4. Ignoring security. Always use trusted exchanges and enable two-factor authentication. If you're investing significant amounts, consider a hardware wallet for added protection. How to apply the 5% plan. Step 1. Calculate your total investment portfolio. Step 2. Multiply that amount by 5%. That's your maximum crypto allocation. Step 3. Choose quality cryptocurrencies. Step 4. Invest gradually instead of all at once. Step 5. Review your portfolio every 6 to 12 months. If crypto grows beyond 5%, you can rebalance by selling some and investing in other assets. The goal of investing isn't to get rich overnight. It's to build wealth consistently while protecting yourself from unnecessary risk. The 5% rule helps you enjoy the potential of cryptocurrency without letting it dominate your financial future. Remember, diversification beats speculation. Invest with a plan, stay patient, and always long-term. If you found this video helpful, give it a thumbs up and subscribe for more videos on investing, personal finance, and building long-term wealth. Now tell me in the comments, do you think 5% is the right amount for crypto, or would you invest more or less? Thanks for watching, and I'll see you in the next video.